to the Money Effect, where I bring you all news, money, and finance related. Just before we get started, disclaimer: this is not financial advice and just strictly for educational purposes, and it's just my opinions. Hit the like and subscribe button if you find the video useful. And now that's out the way, let's go. So 2021 has been an interesting year for the stock market. A lot of ups and downs, definitely not the same year we had in 2020 when we had, one would say, a big crash in March, and then due to all the global stimulus, stocks, just went on an amazing run. They continued somewhat in 2021. Then we've had, kind of two big periods of crashes affecting all stocks, and again, we've had another healthcare, well, the same pandemic issue, but continued. So, looking ahead, I just want to use this video to just basically discuss some of the themes that are basically going to be prevalent going forward next year, and some of the stocks you might want to look at to play those themes. So, I guess the first theme is interest rate rises. We've already seen the Bank of England rose interest rates, and likely because of continued inflation, we're probably going to see at some point next year more interest rate rises. And I guess one of the strongest banks, particularly UK banks, that I would be looking at is Barclays. So, Barclays is a bank that's really, since we're going, this was 2007, and then we had the financial crisis. It's really kind of been in somewhat limbo. Obviously, we've had low interest rates basically for over a decade now, rising here and there by slight percentage increases, but then falling straight back. So this year we've seen, Barclays really pick up. One of the reasons why it's very well capitalized since the financial crisis. There's been a lot of regulations, a lot of stress testing put in. And this year it's just been on a great run. It's continued to grow its investment bank. A lot of its competitors have pulled out in terms of, impairments. And impairments is basically just losses, due to all the government, help from the furlough scheme. People haven't, obviously people have lost their jobs, but there hasn't been mass unemployment as we would have expected, in a normal recession, depression, you call it, because we've had, such government stimulus. We had the furlough scheme. We've had a lot of loans that have been given to all these businesses. So, when Barclays gives you a loan, if you can't pay the loan, it's a loss. They'll write it down as an impairment. That they haven't had that much because of these policies in place. So they're definitely well positioned financially, and they've been really benefiting. If we look this year from increase in inflation and interest rate expectations. So it's definitely, if you're looking at interest rate rises, well, the best place to be is financials. And, these kind of well-established banks like Barclays are going to be to play. You could play a Lloyds, for example, as well, but that's got a lot of exposure to, the economy of the UK. So potentially, this is a kind of place where you want to be looking at. And just as a side note, a 0.110 increase in the interest rates could add 150 million to this bank's profit. So I expect interest rates to keep going next year, and I think Barclays will definitely be one of the beneficiaries of that. In terms of risks, obviously we're still looking at this new variant, and if this, and it's going to be prevalent in basically every stock I pick, because that's going to be the main risk going into 2022. Well, one of the main risks. Particularly the main risk in January, February, is that if we go back to, lockdowns again, and I don't believe, I think we're having some loans back and things like that, but if we don't go back to widespread furlough schemes and we do go back to widespread loans, we're going to see a lot of businesses struggle. We're going to see a lot of higher default rates. And although Barclays is not exposed as, like a more retail bank, like a Lloyds, it's definitely going to affect its bottom line. But I feel like once we get past that, we're getting some positive news on the variant in terms of, yes, cases are going through the roof, but a lot of people are not really, ended in hospitalization if they've been taking the vaccine. So, that's obviously going forward is a good thing, but I do feel that we will have probably more restrictions. But once we get past that kind of smoke, I think the inflation play will be back on and rising interest rates again will be back on. And I'll definitely look at Barclays as, a bank that's going to benefit from that. So again, speaking on that theme, the next kind of theme is inflation. So, we're seeing inflation go up, household bills are going up, we've discussed, energy bills are going up, everything's going up. And, one of the, another way to play the inflation is if we look at people that produce raw materials, and one of those is Antofagasta, which is a blue chip copper miner. And when I say blue chip copper miner, I mean it's just such a big, you know, um, company. A lot of the companies I'm looking at, I'm going to look at the more big ones because we don't really want to get into, these smaller companies, as I'll explain later. But if you're looking at a big blue chip company, this is one of the companies, and you know, everybody uses copper. Copper's in kind of everything that's made. And if you believe that, at some point next year we're going to get demand again, then this is a perfectly positioned. And as you can see, the share price has really been doing nothing in the last few months. It had a big rise in May, and then it lowered its guidance, and we'll talk about why it did that. But in terms of it's a big copper producer. One of the big plays is going to be, I think, electric vehicles. We've seen a great year this year about electric vehicles. You've got your Teslas, even you've got the big companies now like Ford, General Motors. They're all getting into that electric vehicle space. So you've got the smaller players like Lucid. You've got Revlon. If you know what happened with Revlon, again, floated, that did amazingly well. Neo in China, all these companies, but a lot of these companies, they haven't actually been mass producing vehicles. It's a lot of potential and going forward. But in 2022, we're likely going to see these companies start to mass produce vehicles. One example can be Tesla. Tesla's opening a gigafactory in Germany. Don't Google me on what gigafactory is, but it's just a big factory where they're going to mass produce cars, and that's going to be their pipeline in Europe. So one thing we would expect is that obviously they're going to need more copper demand because copper is an essential part of electric vehicles. And I think that's going to be a big play. And also in general, as more demand increases, we're going to see a lot of this come passing on now. Although inflation, you say why? Well, is copper not going to make inflation more expensive? It's going to hit their underlying profit. Not really, because these companies will then pass on the costs, because it's something that's needed. So if copper goes up 10-20%, they're just going to pass that cost on to whoever's buying it. They'll produce it, and we're going to pay for it. So I definitely think this is a stock to be looking at, and obviously it's at a nice price because it's fallen from its highs. And if we look, that was its all-time high. It's really at a nice price now, so definitely something I'll be looking at. Also, it's got a good dividend yield, and the dividend yield, in essence, is just an interest that you're going to receive for holding this stock. It's currently at 4.7%. Inflation is around 5%. But just holding the stock, you're not going to lose any money. And obviously, then you have the added benefit as if you get that capital appreciation, i.e., if the share price grows, you're going to end up getting more money. So definitely, if you're looking to play the raw material space, it's a company you should be looking at. Obviously, one downside is that China tends to, their demand, I think, in the whole copper worldwide is like 50%. And obviously, China having a lot of problems now, not only with the regulation, but with things like Evergrande and, slowing demand there. So that's definitely one to play out on. But it might already be factored in the share price because that was really what caused this slump here, that they produce lower guidance going forward. So, definitely a company I'll be looking at, and one to keep on your radar. The theme is raw materials is a great way to play the inflation hedge. So definitely something to put in your wish list or want list, or I don't know what you'd call it now. Next company we're going to look at is NVIDIA. Now, NVIDIA, if you've never heard of NVIDIA, you should know it because it's used in everything. So it's a chip company, and obviously they've been benefiting from the global shortage of chips, which is increasing their prices, which is they're doing well. And you look, you can see they had a fantastic year, and I do expect this to go on. And because chips are in everything, so you've got chips in phones, chips in PlayStations. If you think that 2022, once we get past this little new variant square, demand's going to keep going again. People are going to keep buying these PlayStations. This is the company that is going to be at the forefront of making them. It's also used in cloud. So if you know about the cloud, you've got Amazon Web Services, Google Cloud, Microsoft Azure. NVIDIA chips are basically used in their data centers. The cloud is going to keep going and going. Companies are producing so much into this. It's a big part of Amazon. Amazon is was one of the biggest companies in the world, and the cloud is like one of their biggest parts. So NVIDIA is somebody that supplies their chips. So it's just going to keep going, keep going, keep going. You know, Again, even if we go into lockdown, you're going to see more gaming, PC gaming. That industry was prevalent in the lockdown. I think it's just going to keep going. And again, Nvidia is their chips are used. Hyperscale data centers, again, their chips are used. And then some of the themes going forward, you've got artificial intelligence. We're hearing about robots are going to take over the world. Go watch iRobot. Will Smith, if you believe that's going to happen one day, well, Nvidia, they're the chips that are going these iRobots. So again, booming. Augmented reality, and one of the buzzwords of this year in the crypto space has been metaverse. So the metaverse is basically making virtual reality real, and I won't get too much into it, but again, if you look at some of the features that's coming in, uh, well, Facebook, which is now known as Meta, they've got augmented reality headsets, and that's the next play. And if you look at what goes into that, well, chips and designs, that's all NVIDIA. So again, it's another play if you believe that's going to keep going to 2022. Also 5G, we're rolling out 5G, and NVIDIA is literally well positioned. Uh, One of the risks, obviously, is if we go back into a lockdown, the supply chain issues could continue. We've had big supply chain problems. That's why you've seen a lack of things, but it hasn't really affected NVIDIA's share price at all. But if we do go into some kind of proper lockdown again, supply chain issues is going to be something to look out for. Also, this company is what we'd call a growth company, so it's had mass growth. Can it continue its growth? I believe it can, but potentially, we've risen so fast, you might want to wait for like a dip. But definitely put this company on your watch list, and any kind of significant pullback, I would jump in. And with the growth argument, we've got interest rates. As interest rates go up, um, it tends to hurt growth companies. Now, Nvidia is it's like, look at its market cap. It's nearing the 1 trillion market cap. So it's not something you would call as a typical growth company that's not making money, not making revenue, but interest rate rises can hurt it. But it's definitely, for me, this is a company that is really, going to join the trillion club soon, in my opinion, because of all the plays it's in. And if you're somebody that believes in artificial intelligence, believes in metaverse, believes in 5G, this is the kind of company you want to keep your eyes on. Believe in the cloud. It's really everything that is in the future. This company is driving, as in background, the processes, the chips. Obviously, there's competition. This company is beating out. You've got AMD, you've got Intel. This company's kind of surpassed them. But those companies can make comebacks. Intel are working on a lot of stuff. They're basically revamping their whole company. Maybe they'll take the throne back from NVIDIA going forward next year. I personally don't think so right now. But again, it's something you have to, you know, factor in. But for me, this is definitely a stock that I would put on, my list of things to own, big companies to own that, I think is potentially going to wait for maybe a correction, but definitely something I would own. So the next company I want to look at is Alphabet, which we would know to be Google. And again, I think we all know what Google does. We all know what Alphabet does. I want to say, so, we have this would be considered a growth company. Now, growth companies is something that tends basically doesn't create revenue and just use all this money to grow. Now, whether you can say that about Google anymore, I don't think so, because yes, before it was a growth company, and look how the amazing growth. But now this is a big tech company. It's worth nearly 2 trillion. This is not a growth company no more. Or nor could it be said as a value company? Is it an undervalued stock, or is it relatively priced? So it's hard, but it's definitely big tech. Big tech, Apple, Microsoft, Google. That's it. Big tech. And you see over the last year, this company has done well, and dare somewhat say, is this company a safe haven? Because of all the pullbacks that we've had this year, we've had two significant pullbacks, one in April, May, one around September, October. This company has either kept rising or literally stayed in line. We had when interest rates were first muted from the Federal Reserve, so many of these growth stocks, pure growth stocks, have tumbled. And we all know what they are. Like if you look at even the big growth stocks like a Square, Coinbase, these kind of companies, really Robinhood, that's just in America, that they've really suffered from the expectation of interest rates increases. But Google, which is in history a growth company, it's really been stable. So it's definitely more along the lines of big tech. I'd probably put it in the middle of a growth and value company. And where's it going to get its revenue from? Well, one reason we say it's a growth is digital advertising. It's basically the Alphabet Google platform. People advertise. You're seeing adverts here, right here. This is in lockdown where everybody was sitting at home. You know, um, people were watching these advertisements, but these companies weren't paying that much because they're thinking, what's the point in advertising if people are not going out to buy the product? But as the advertising from revenue from Google's perspective is actually near the levels of 2019. So I expect, again, apart from January with this whole lockdown, I expect um, digital advertising revenue to keep on increasing, and that's definitely going to benefit Google. And then at the same time, if we do go into a lockdown, you know, Google owns, what does it own? YouTube. YouTube. Everybody uses YouTube. On, you know, if we go back into a lockdown and everybody starts going back onto YouTube again, it's only going to benefit Google. We saw, look, in the drop wasn't even significant, and then since then it's actually taken off. So either which way, this company is definitely positioned, to benefit from as we continue to, maybe we'll have a blip in January, but after that, once we get this new variant under control, the economy keeps on moving forward. Google's going to benefit. If we go back into lockdown, it's going to benefit. And also, so they're working on so many other things, they're big in the cloud space. Now, at the moment, the cloud space is dominated by Amazon. Yeah, AWS, that's Amazon Web Services. They have like 30% share of the global cloud market. They're generating 45 billion. I think Google has about 9% share. They're generating about 12, 13 billion in revenue a year. They're really putting a lot of emphasis into their cloud business. And if they can only get to half of what, they can get another 5-6% growth, taking out Amazon, that's still adding billions of revenue to this company. So there's a lot of this. That's why we say it still technically is a growth company, because there's a lot of areas for it to grow. And again, that could be another factor. Obviously, they're working on other things, as in they've got a couple of partnerships. Google's a company that's cash rich. Growth companies, they tend to be cash rich. More times they use that cash to buy other companies, invest, and that Google is doing that as well. They've got the self-driving partnership with Waymo. They're buying all these companies to try and push their growth, but at the same time, again, this is potentially why we could say it's in between, is that they're giving back to shareholders. They're doing a lot of stock buybacks, which is helping share price go up. So this company is definitely on one of my top picks. I'd say it's probably my top pick going into 2022. So I just don't see it ever dropping, unless we're going to get into the risk, but I don't see it dropping massively. and I think it will just maintain its growth position. And it's definitely a nice place to park your money. It will definitely get you more than interest rates. Obviously, one of the risks and the different risk to Omicron is that regulation. Big tech companies, they're in the sights of Congress in America. Have got so much power, and Google is definitely one of them. Out of 9 out of 10 phones is run on Android, and although we love Apple, or people love Apple, Google, is dominant in the that space of operating systems. So Congress are looking to rein them in, maybe even split them up. You split it up, so you have YouTube, so you have a YouTube business, you have Android business, you have um, advertising part of Google, the cloud part, and they're all kind of independent in theory, and that's what obviously Congress want them to do. But whether they want them to do that, it's not going to happen in 2022. It's definitely something that's going to be, you know, going down the lines, and yeah, that's definitely a big risk, though, regulation risk. So, when you hear about, it's not really been in the news as much, but I'm sure we'll get back to that about breaking up Google, and that's definitely going to be a big risk for the company. Again, another drawback is depending on how you're investing. One share is nearly, $3,000. So, if you've got an account where you're able to get the smaller shares, then definitely perfect for you. If you're investing in one of the traditional platforms like a Hargreaves Lansdown, and you invest, one share is going to be 3,000. That might be a lot more than your portfolio is worth. And again, you're probably better off getting an um, an investment fund or trust, something that's got a portfolio. But if you're somebody that has got a free trade account where you can get these smaller fractional shares, this is definitely one I would have on the list. So the last two companies I want to discuss, and the theme, of course, is going to be definitely prevalent to the new variants or any lockdown. So we've seen, going into November or December, this new variant that come from South Africa allegedly. It's really kind of got economies in fear now. Most economies um, are not doing full blown lockdowns. We've had some countries like Holland in Europe, Austria that have done, 3 week lockdowns. If we stick to the UK, we're not in a full blown lockdown. We're definitely in a lot of restrictions, and travel restrictions is going to definitely be the one. So this company Jet2 is basically provides travel packages. So travel is the key word. Any kind of full blown lockdown, we're going to see this company drop. If we look at what happened, look, this is where it was when we had full blown lockdowns. Lost what, triple its value. So if we go back to that scenario, we're really going to be stung. And if you see here again, we look going into September when these restrictions were announced, we've had big drops. Now, one of the reasons it's not dropping as much is because there is a general consensus that we're not going to go back into a full-blown lockdown. Yes, cases are rising, but these vaccines that are being produced seem to stopping hospitalizations and serious deaths for those that have been vaccinated. It's not as mass as it was before, and obviously, likely we're going to get more boosters and vaccines going into the new year. But I do feel we will have more restrictions in the new year, so likely this stock is going to drop off more. But if you're a long-term hold investor, this is definitely something you should be looking at. And again, it's a catch-22 here because, it's all about timing sometimes, but then you can't time the market. So it's contradictory statement. You could get into this company now and, we get into a lockdown and we drop back to these levels and you're like, oh, damn. And now that's when you decide, do I have conviction for this stock? Am I willing to hold it? Do I then double down and invest more at these lower prices to take down my lower cost? Or you say, you know what, I'm just going to wait and see. And if you wait and see and it goes lower, you're getting a better price. If you wait and see and we don't have further restrictions in the new year, then you could just see this company go up 10, 15%. And at that point, do you decide, is there still enough in there for me to be interested? So you have to bear those factors in mind. But definitely, um, people want to travel. People definitely, they're eager to go out. We've seen it in 2021. People taking vaccines just to travel. This company's, if you look at we take everything from 2019, they've got bookings is equal, capacity is equal, to 2019 levels. Obviously, that can stop if people cancel because of this ongoing. But I do believe, like, once we get in, once, maybe we go through another more restrictions in January, February. But I think once after that period, with companies like this, it's definitely a way to play that are reopening and of this variant receding. And in terms of cash, there's a lot of other we've got TUI, for example. TUI was bailed out by the German government. That's really in a bad position. But this company, they've raised funds. They've got a good, healthy cash position, about 1 billion on the balance sheet. So they should be comfortably. But again, full-blown lockdown puts that all out of the window. But if we don't go into no football lockdown, we just get some more restrictions, definitely well positioned to take advantage of reopening and people's eagerness to travel. And I think everybody can relate to that. So if you're somebody that's thinking, I'm definitely traveling next year, this is a stock for you to hold. Again, on the same lines of that, we've got IAG, but obviously IAG owns British Airways. This is a pure play airline based. Again, same risks. If we go into, it's not hard to see. We go back into 5 years, we see where it was, and then full-blown lockdowns, and it's not, obviously it's recovered somewhat. We hit 200 in around April, but it's still lower. And again, I believe that it's definitely a stock to keep an eye on if you believe in this whole variant receding. Restrictions might not be as bad as they were. It's definitely one to keep an eye on. One problem it's had is the long haul flight disruptions, because those tend to be the most affected. Traveling to America, having to take all these tests, going international, and that's obviously IAG, British Airways, baby. But also, they are going to start reopening short haul flights that stopped from the pandemic in March. Domestic travel has been less affected from these travel restrictions, so that's going to definitely now be another avenue for British Airways to proceed. Obviously, they had a takeover of Air Europa that got cancelled, so they've got a lot of cash on their balance. They've done a right issue. They've cut costs as well during this pandemic, so they're kind of very well positioned to keep going, I guess, apart from another full-blown lockdown. So if you don't think we're going to get into a full-blown lockdown, definitely a company to watch. But I reckon, let's see what happens in January. Get more restrictions. I think some of these companies will come back at nice prices. Listen, you could get into this company today, I feel, but just be prepared to either hold it or, again, use a strategy about average costing. But, definitely a company that I would keep my eye on. So, yeah, just for me, the money effect, just some of the companies and themes that I think people should be, keeping an eye on. Like I said, maybe not all these stocks are ones to get in today unless you're comfortable, but you're going to have conviction to hold and then add to them or whatever. But definitely stocks to keep an eye on. Wait to see. A lot of them, the number one is the variance, so wait to see how that plays out and then get into it. But just some stocks for 2022, I think people should be keeping an eye out. So thank you for listening. This is my channel, The Money Effect. Please like and subscribe so the YouTube algo can, start liking me and showing me love. And yeah, have a good 2022 or more travel.